Do you want to lose money by paying high fees? Do you want to entrust your assets to professional fund managers and underperform the market average? The answer is simple. Invest in low-cost index funds. Avoid the fee trap. Why is this the right approach? This slide explains it all. The latest SPIVA scorecard, year-end 2023 edition, shows this clearly. About 88% of large-cap active funds underperform the S&P 500 over 15 years. About 82% over 10 years, about 75% over 5 years. The longer the period, the higher the failure rate. These are the numbers after fees. Survivorship bias is also adjusted. These are the true numbers, including funds that disappeared. Professional fund managers, analyst teams, cutting-edge technology. Even with all of this, about 90% can't beat the market average. This is a statistical pattern that S&P Dow Jones Indices has consistently demonstrated. And what you need to do is clear. Avoid high-cost active funds. Switch to ultra-low-cost index funds with expense ratios of 0.03% to 0.10% annually. This protects your wealth. Today, I'll show you the mathematical proof. Now, let's look at the specific numbers. This is a simplified calculation example, assuming pre-tax, nominal, constant returns, but it demonstrates the long-term impact of fee differences. This is the difference between an index fund with a 0.05% annual expense ratio and an active fund with a 1.5% annual expense ratio over 40 years. Assuming an initial investment of $100,000 and an 8% annual market return. Subtract the index fund cost of 0.05% and the net return is 7.95% annually. After 40 years, approximately $2, $134,000. On the other hand, subtract the active fund cost of 1.5% and the net return is 6.5% annually. After 40 years, approximately $1, $242,000. The difference is over $890,000. This difference is created solely by the cost difference. The fees you paid have created an opportunity loss of about $900,000. Fees will certainly drain your wealth over the long term. Why can't professional managers beat the market? There are two answers: cost and mean reversion. Analyses from Vanguard and others shows this. Funds that recorded strong performance don't have strong persistence in staying at the top in the next period. Short-term success is a mix of skill and luck, and over the long term, mean reversion works. Some years outperform the market, some years underperform. Ultimately, most converge to the average. This is a fundamental law of statistics. There's an even more important fact. Since the portfolio held by investors as a whole is the market itself, the average of active management as a whole, after costs, tends to fall below the market average. This is an arithmetic truth. Funds that outperform can exist, but identifying them in advance is extremely difficult. It's not just costs. Taxes are also a problem. In taxable accounts, the higher the turnover rate, the more taxes increase, and after-tax returns tend to worsen. Active funds tend to have high turnover rates. Actual turnover rates vary greatly from fund to fund and can be confirmed in the prospectus. Frequent trading generates short-term capital gains taxes. In the U.S., short-term capital gains tax rates are the same as ordinary income tax rates, reaching up to 37%. In Japan as well, the impediment to compound effects due to tax burden is similar. On the other hand, index funds minimize trading. Most gains are subject to long-term capital gains tax rates, primarily around 20%. Additionally, in-kind redemption in ETF structures can contribute to tax deferral. The magnitude of tax costs varies depending on account type, tax rate, and turnover rate, so it can't be generalized. But index funds, especially ETFs, are designed to be highly tax efficient. And the most overlooked problem: psychological burden. When you invest in active funds, you're constantly worried about performance. Are you outperforming the market? Are you better than other funds? This anxiety creates the worst decisions. Research shows this. Due to investor buying and selling timing, actual investor returns tend to be lower than the index. In Morningstar's recent analysis, the gap over the past 10 years is about 1.1%. The reason is emotional trading. When the market crashes, you sell in fear. When the market rises, you buy at high prices out of greed. Active funds have high pressure because there's an expectation to outperform the market. When they underperform, you sell in anxiety. On the other hand, index funds have clear expectations. You bet on the growth of the entire market. Even with ups and downs, you can understand that this is normal. Psychological stability supports long-term success. Now, let's summarize the advantages of index investing. First, you bet on the growth of the entire market. The total return of the S&P 500, including dividends, varies by period, but has been solid over the long term. If the American economy grows, you win. Second, minimal cost. In the U.S., many ultra-low-cost products range from 0.03% to 0.10% annually. Third, maximum tax efficiency. Because trading is minimized, tax burden is also minimal. Fourth, psychological stability. The clear expectation of tracking the market average prevents emotional trading. Fifth, maximum diversification. With the S&P 500, you hold 500 stocks. Even if one company goes bankrupt, the impact is limited. Sixth, zero manager risk. No human judgment errors. Seventh, maximum transparency. It's always clear what you're investing in. And the facts prove this. In the U.S., by 2024, passive management asset size surpassed active management. Smart investors have already made the move. Now, let's organize today's key points. Here's today's summary. First, statistical facts. In the latest SPIVA Scorecard Year-End 2023 edition, about 88% of large-cap active funds lost to the S&P 500 over 15 years. These are true numbers after fees, adjusted for survivorship bias. The longer the period, the higher the failure rate. If even professionals can't beat the market, individual investors have no chance. Second, the compound effect of costs. An ultra-low-cost index fund at 0.05% annually versus an active fund at 1.5% annually. This difference creates an asset difference of about $890,000 over 40 years. Fees are hard to see, but they're the most certain enemy stealing your wealth. Third, the advantages of indexing. You bet on the growth of the entire market. Minimal cost, maximum tax efficiency, psychological stability. This is the rational strategy for winning at long-term investing. And in the U.S., by 2024, passive management surpassed active management in asset size. The market has already provided the answer. Note that not all active is the same. There are low-cost active funds, with low trading and rule-based management. However, considering the difficulty of selecting funds that will continue to win in advance and the certainty of costs, indexing is rational for most people. What fund are you investing in now? What's your annual expense ratio? If it's over 1%, you should review it immediately. Share your investment strategy in the comments. Your questions, your choices, your experiences. Everything becomes the wisdom of this community. Thanks for investing your time with me today. This channel explains specific strategies for index investing, asset allocation, and financial freedom with numbers. Not beating the market, but growing with the market. If you want to gain that confidence, subscribe to the channel. Turn on notifications too. See you in the next one.